In this week's update, is the bear market about to return? The case from both sides, and what the Fed had to say and what the market thought. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. Last Sunday, I said that I would look at the case for the bear market being over or not over, and specifically looking for evidence that the bear market was still in progress. So this is that video. Most of the material was prepared before Friday night, so before the US market turned down quite sharply. So it's just coincidental that that happened, but it was always my intention to to present the video in this particular format. So the overall market perspective, I guess, as any of you that have watched these videos for any length of time should realize now that I'm an observer of money flows. I don't get too hung up on one position or another. I try and keep an open mind, and I just look at the evidence, and I build the weight of evidence on one side of the ledger or on the other. I don't look at what logically should happen or what my biases suggest should happen. And we've all got biases, and they're sometimes hard to combat, but the more open-minded you can be and just rely on the weight of evidence and have an open mind, then the better off that you are. Those who take a strong predictive view, as we see in the media and as we see on social media, are always going to struggle big time. Because having, logic, most of the time, more often than not, logic does not translate to the outcome that you would expect. So if you're pinning your hopes on logic, then you're just way off the mark, and you're going to consistently struggle with the market. And, that comes from 35 years of experience in the market. So those who like to take a strong predictive view for whatever reason, I'd really suggest that you take a good hard look at that, because it just doesn't work. Now, since mid-June, there's no question that the market has changed. And the weight of evidence for the end of the bear market continued to build, as has been recorded through these videos on a week-by-week basis. What it required was a certain level of contrarian acceptance, though, to be able to acknowledge it. And it seems from the comments that we had on these videos that, some people couldn't accept it because they were so firmly rooted in their belief that the bear market was still ongoing, and they couldn't actually acknowledge the weight of evidence that was, that was right in front of us. But there's no question that that weight of evidence was there. And if you've been watching these videos over the last 3 months, then you'll know that that's the case. At no stage did I ever make, some grand prediction. It was just a sequential, week-by-week identification of the evidence that was building. But it's always good to test your thesis and look at the reverse case. So look for evidence that the bear market is still in vogue, because it's not that difficult to filter the information to suit our bias. It happens at a subconscious level. So this is something that I do quite regularly anyway. I just look for evidence on the opposite side of the ledger just to make sure that I'm not missing anything. And so this video, the first part of this video is about that. And then we're going to line it up against the weight of evidence that has been presented over the last 8-9 weeks. The mass media has a lot to answer for, and they mostly serve up completely misleading rubbish. And that is why the herd thinking still favours the fact that the bear market is not done, that it'll come back. And I'm sure there'll be many people after Friday night in the US will feel vindicated and point to this very significant market downturn. But we got to look at that in perspective. So hold that thought. It's possible. I'm always open-minded to the market doing something different. So, could they be right? That's really the question, and I want to look at it very much from that perspective. We see the herd thinking playing out in the views on this Sunday video. There's no question, we've got the factual evidence to show it, that the number of views intensify when things are really bad, and the number of views drop away when conditions improve, as we've seen in the last 6 to 8 weeks. So it's very starkly obvious to us, running this business and presenting this video every week, that people really are, that their psychology is working in the exact opposite way that it should do. You should be looking for opportunities when things are bad. The views should be going up when things are bad, when things are turning around, and the opposite seems to be occurring. So, having said all that, let's look at the bear case. So, there is any number of fundamental reasons why the bear market is not over and is going to come back. And look, you can all make a long list, and this is by no means a definitive list, but these are the main things. Inflation, which everybody knows about, leading to higher rates, and certainly the Fed commentary on Friday night, was pretty hawkish. So you could be excused for thinking that rates are going to go up significantly more in the US. The possibility of a recession. If there is a hard economic landing, then we end up with a recession, and recession hits the earnings of companies, which means that the valuations could be still too high, and therefore stock prices have to go down to adjust. China, we've already got a property bust on there. How it actually plays out remains to be seen. China has got a very ailing economy at the moment because of the COVID shutdowns, and they're now introducing more stimulus, which is certainly a sign that they're concerned that their economy is in a bit of strife. We've then got Taiwan and the possibility of some sort of significant conflict over Taiwan. And of course, we've still got Russia and Ukraine ongoing, which is having its impact on energy and food prices, and hence feeding into inflation. Then we've got extraordinary debt levels around the world that have been building for the last 10 or 15 years. And how will they be impacted by higher interest rates? And then in some US sectors, we've got excessive valuations. Not all, but some. And that's at a time when earnings per share growth is slowing. So it's not hard to come up with a shopping list of fundamental reasons why the bear market must continue. And this is what a lot of people are doing. But as I said earlier, the number of times, in fact, the vast majority of times in my experience, the fundamental case doesn't play out in the market in the way that you would expect. And I'll have more to say on that in a minute. So there's no question that you can make a very, very compelling case for the bear market to resume. No question at all. Before we get to the bullish case, though, let's now look at the... let's get rid of that. Let's look at the technical evidence. So we've looked at the fundamental evidence for the bear scenario. Let's look at the technical evidence. So we've got, you'll notice this is the S&P 500. We've got a strongly downtrending line, and the market had bounced, or the index had bounced to that downtrending line. It had also bounced to the 200-day moving average, which is now has now well and truly rolled over. And we also had the resistance formed by the peaks and troughs through here at this level around 4,300. So those three areas all combined to provide a nice, neat little area where the market could run out of legs to the upside and turn down. And so far, that's what it's done. I also make the note that bear market rallies look very similar to bull market rallies. If you look at the shape and the nature of them, it's very, very hard to tell the difference. So therefore, it's a bit of a question mark as to whether this is just a rally in an ongoing bear market, or whether it is the start or the resumption of the secular bull market. Another reason is that this could have just been short covering. And we certainly saw that in a lot of the, the more speculative stocks, where there were large short positions, and they've rebounded in some cases quite spectacularly. And so I think there's a certain level of validity to that it is just, this rally is just short covering. What we do need to see, though, if this is going to be a valid analysis for the bear market, is that we need to start to see volumes expanding again to the downside, as we saw in April. If you look at April here, once we started to turn down again in April, look at the way the volumes picked up to the downside. So that's quite clear. So we need to see something similar to that for the bear case to be valid. The other thing that we also need to see is the aggressive sector leadership, which has been the case since June. That needs to fail. So we need to see technology start to be one of the weaker relative sectors. We need to see consumer discretionary part of the weaker relative sectors. So we'll look at those charts to see if there's any evidence there that that is the case, because certainly to date, that part of it has been extremely positive and very supportive of the bull market scenario. Now, if we look at the NASDAQ last night, it was quite a sharp move. And the NASDAQ wasn't able to make it back to the 200-day moving average and has now turned down and has now broken this important support. And the volumes were up on the NASDAQ as well. Prior to last night, it wasn't nearly as impressive, if you like. It's not quite the word I'm after, but that'll do. But certainly on Friday night, the US market in total turned down, but the NASDAQ is only performed slightly worse than the S&P. So again, this is ARKK, which is Cathy Wood's ETFs, and this has really been, the stocks like these were the epitome of the market excess that led into 2021 and the decline since the start of 2021. Now, the bear case here is validated by the fact that the bit of an uptrend that we saw didn't really have much volume associated with it. It certainly didn't have the volume that you would expect. There was a very, very slight increase. But we should have seen something far more robust if this indeed was something valid. And again, looking at going forward from here, and we don't have enough evidence at this stage, but going forward from here, we should start to see volumes expand on the downside. Now, we did see that on Friday night, but that's only one session. So we need more data here. But certainly, charts like this certainly do validate the bear case. But, there's a lot more to the market than the speculative end. So the conclusion on the speculative end of the market is that the jury's still out. So in that case, stay away is the only conclusion. Now, following Friday night and the sharp downturn, I now want to look at, is there evidence that the more aggressive sectors are failing relative to the rest of the market, and are the volumes expanding on the downside? Because that would tend to that would tend to add weight to the bear case. So this is XLK. Now, it's a sharp move, but all of the sectors were down sharply, and the volume was up a bit, but nothing particularly notable. It wasn't like this or here, many other occasions that we saw. But let's keep an open mind, because in terms of price, that was a significant move. It's one of the bigger red candles that you can see in the last 6 months. Let's look at XLV. This is healthcare. Healthcare, typically defensive. Healthcare hit hard. Volumes expanding. So that sort of sends a bit of a mixed message to me. This is consumer discretionary. Certainly down hard on Friday night, but volumes hadn't really changed. Let's look at some individual stocks. Apple, sharply lower, volume increasing. Let's see where that one goes. Google, the same situation. Sharply lower, big candle, big range candle, volume higher. Microsoft, same story. So big tech is certainly seeing volumes expanding. So there's no question about that. But as I said earlier, this is not a market, and I've been saying this for years and years and years. You shouldn't make decisions about whether you're in the market or out of the market based on the indices, because there's always some good things happening. And if you look at XLE, which is the energy sector in the US, you can see just how much differently this one is performed, and still is. And if we look at the performance of XLE on Friday night, whilst it fell on quite modest to low volume, and looking across 10 or 20 different stocks in the energy sector, they all look the same. So yes, it went down a bit, but relatively outperformed the market very easily. So that's the situation for the bear case, and there are certainly things there that we need to watch. And Friday night has at least opened the possibility that we'll see more market downside. Now let's just recheck the bullish case, because this is what I've been talking about for the last 8-9 weeks. So what have the money flows been saying for the bullish case? Well, if you've been watching these videos, you'll know very clearly what all the elements were. We had a rotation to the more aggressive sectors. We had signals, multiple signals in the bond market since before June, that the bond market didn't believe that interest rates were going up. The options market had reached a contrarian extreme. That was another box ticked. This is really interesting. Bear market rallies really get past the 38.2% level and almost never go past the 50% retracement level. And that's just a fact. And if anyone disputes that, then, do the work and go back and look at the last 20 or 30 years of bear market or rallies in bear markets, and just, test that theory yourself. But, I've done it, and the reality is that's how it works out, because if we're still in a bear market, then you shouldn't get too much upside. Yet and we'll look at that chart in just a minute. But the other thing is that we were seeing very positive reactions to poor news. And you look at a stock like Nvidia, for instance. Nvidia came out with pretty ordinary results and pretty ordinary outlook, but the market reaction was extremely positive up until Friday night, of course. But prior to that, the market reaction was extremely positive, and that is not the hallmark of a bear market. That is the hallmark of a bull market. So let's look at some more charts. Then we'll go back to the S&P and look at this particular point. So I've put the Fibonacci scale on this from the lows in June back to the highs at the start of the year. The 38.2% level came in here. There's the 50% level, and you can see that the market actually rallied not quite to the 61.8, but certainly well in excess of the 50% level. So that certainly supports the bull case and weakens the bear case. Now, I did write prior to Friday night that we were getting a retest of the breakout on declining volume, which is what we had. So you can see the volume there declining over the last 5 or 6 sessions, but of course Friday night changed that. Now the key thing is Friday night just one of those sessions, just an overreaction to a very hawkish stance by the Fed, and it will, life will go back to normal next week. And often that happens. The algorithms, they get into a selling pattern and they just sell and sell and sell all the way into the close, and then next week it's like it never happened. Now, I'm not suggesting that is the case this time. This is a pretty emphatic move, so I tend to think there'll be some more downside here yet. But let's not rule out the possibility that that this is just a bit of an overreaction. And certainly the volumes were up. Let's look at the important spreads that we look at all week to see if there's anything there that we can ascertain. This is the NASDAQ versus the S&P. We're still forming higher highs and higher lows. So where's the line in the sand? The line in the sand is there. We really don't want to see this ratio drop below this line. So that will be one to watch in coming weeks. This is the Dow Jones Semiconductor Index, and this supports the bear case to a degree, because in a good healthy bull market, semiconductors should be one of the strongest sectors, and clearly it's not, and it hasn't yet started really forming higher highs and higher lows, other than on a extremely short-term picture. So I'm really looking for the semiconductor sector to turn up. So that's one that needs to be closely watched. This is consumer discretionary versus consumer staples. Again, higher highs and higher lows. You could possibly argue that we've broken a prior low, but it was a fairly short swing. So I'm prepared to give it a bit more latitude, maybe down to here. But again, this is an important ratio. We really don't want this line dropping too much further. This is the Dow Jones mid caps versus the S&P. We still don't have lower lows yet, but we're heading in that direction. So again, it needs to be watched closely. And this is that was the Dow Jones Semiconductor. We've already looked at that one. Now, just again, supporting or providing evidence so that we're looking at everything. This is ExxonMobil, so one of the components of the XLE, which we looked at before. Still looks very positive, even after Friday night. So this is what I was talking about with the XLE. It's only a very minor move to the downside. No volume expansion. So this was not across the board selling in the US. That's the key thing. Apple we looked at, it was extremely bullish. Members took a position in Apple on July 6 and have done extremely well out of it. Now, the turn down on Friday night certainly does look pretty ominous, and I would be most surprised if we don't get further follow through to the downside on this expanding volume. So that's the case for Apple. In Australia, for those that focus more on the Australian market, this is an example of the opportunities that have been in the Australian market. This is Pilbara Mines, and this isn't a recommendation to be buying at any particular price, to be honest, but certainly not up here. But these stocks, they're in a mega trend. That means that they've got a tailwind to revenues and earnings for a long period of time. The fundamentals are extremely compelling. It's not expensive, and the reward for risk is highly compelling, particularly when it was down here. When the panic set in. So when people were panicking, this is the time that you should have been scooping up these sort of stocks, and they've rebounded very, very strongly. So irrespective of whether this turns out to be just a rally in an ongoing bear market at an index level, or whether it is the resumption of the bull market, as I've been building the evidence over the last 8 weeks, there are some parts of the market that still provide extremely good opportunities. I'll come back to that one. Okay, so having done all that analysis, I then sort of sat back and said, well, what's the conclusion here? What does all this information mean? And one of the things that struck me is, if the justification for the bear market is the fundamental reasons, and the fundamental case is very compelling, but that's always been the situation. Forever and a day, equities have scaled a wall of worry. And I'm sure that, if you've had any association with the market, you've heard that term many, many times, equities climbing a wall of worry. And it'll continue to be the situation. And that is why, if you're basing your expectation that we're still in a bear market purely on the fundamentals, then I just don't know whether you're going to get the right outcome. I really don't. I think you need to place far greater weight on the technical picture, but don't fall into the trap of just looking at the index technical picture. Look at it on a sector-by-sector basis, and I think you'll find that there are some sectors that absolutely are not in a bear market. The technical evidence, as I said before, the recent rally, it went further than normal, and there really are a lot of bullish chart patterns. And even on Friday night, amongst the carnage, there were still some pretty bullish chart patterns maintained. So the conclusion that I came to is that the weight of evidence still supports the bull case. I gave the bear case every chance, and I'm open to the fact that with the Fed being so hawkish, we could see some significant follow-through selling. But the weight of evidence is still very much in favour of the bull case. But, just keep an open mind, be flexible, because it was just a single session. I've been tricked up by the US market and the way that the algorithms affect that US market, on more than one occasion. And a period of consolidation wouldn't be out of favour at all. So the way forward from here, if the market outlook changes, then shift tack accordingly. Don't stay out of the market because it might be an ongoing bear market. There's money to be made. And in any case, the signs are always obvious well in advance. Just consider the commentary that I've been providing and the weight of evidence I've been building all year. I turned bullish in January. In fact, bearish, I should say. In fact, I made some bearish comments in December about things that I was observing. So, I'm on record as painting both sides of the picture here. The reality is that we've got some of the strongest mega trends in history. And, that increases our odds of success. And I don't think electrification or decarbonisation is going to go away anytime soon. You really need to avoid treating the market as a single index and get your focus squarely on the sectors that are working. So how to proceed from here? Well, I think there's a need to act and think differently. Develop a game plan that's suitable for your needs. Have a big list of qualified investments. Try and buy just on your terms. Don't chase prices. Wait for weakness. And that's why having a big list of qualified investments is good. Have, at least double or triple the number of targets that you plan on buying, because then you're not influenced to chase prices up. Find someone whose opinion you can trust, because keeping your head straight when the media is being as misleading as it typically is, and particularly at the extremes, the worst possible time, it's very easy to get, shuffled down the wrong path. And cultivate patience. You don't have to be in and out of the market on a very short-term basis. So look, hopefully the Sunday videos have helped you cash up early in the year and then were able to take advantage of that rally since June because of the cash that you had. If not, it's not too late to do it. If you're nervous or you're unsure about how to do it, I can help with that, and I do help with that with members. There's a $1 trial that you can undertake to understand the methods that I use better. But before I touch on that, let me just talk about the Insiders Club and what that may offer some people. There are a lot of specific recommendations in both Australia and America. Specifically what price, what day, both entries and exits. There's a lot of strategy and trade perspectives in the Insiders Club and a lot of email support. If you don't feel that you're ready for that step, then there's still the $1 trial, the Portfolio Analyst. The details of that, it's a 14-day trial. You've got 4 years of archives, weekly archives. So hundreds of hours of video and education. There's a lot of qualified trade ideas, and the Q&A session where members ask questions for analysis about specific stocks is especially valuable. On many occasions, I've been asked questions about stocks where I've been able to steer members away from those stocks because they've got elements of risk that they just weren't aware of. And so I'd like to think that that's saved members a lot of anxiety and money. But equally, on some occasions, there's been some absolute gems raised that they were stocks that I wasn't aware of. And we had one just in the week just gone, which I'll show you, which is a stock called Anson Resources. And again, this is not a recommendation, but it was a question raised by a member. I didn't know anything about the stock, but when I analysed it, there was quite a lot to like, and the stock price has absolutely rocketed away from the mid-teens up to to the high 20s. So that's proven to be a pretty valuable source of ideas and information for members. Look, my focus, the reason that I do this, my focus is always been to help as many investors as I can by providing an independent and open-minded perspective on the market. And I hope this video, which is a bit different to the normal Sunday video, has challenged your perspective on how you think about the market, how you look at the market. And even if my services aren't for you, then I do encourage you to continue to watch every week. Keep your focus on what is rather than you think what should be. And always be open-minded to change when the signs tell you. So that's it for this week. A bit of a different one, but I thought it was very timely, and I'm sure there'll be a lot of fodder to analyse over the coming week. So I'll be back with you next Sunday. Cheers.